Good afternoon, everybody. Thank you for being here and welcome to our office here at Pitcher Partners for our federal budget Sundowner event. For those that are in Melbourne, you may not have seen the sun for quite a few days. It is still up there, I'm told. It sets sometime at 5:24 precisely, actually, this evening, so hence the Sundowner. My name is Brian Farrelly. I'm a partner here at Pitcher Partners and part of the tax advisory team. Before I begin, I would like to take a moment to acknowledge the Wurundjeri people of the Kulin Nation, who are the traditional owners and ongoing custodians of this land on which we all meet today, and pay my respects to the elders past, present and emerging. We're delighted to host you all here today to analyse the government's second federal budget and what that means to you, our clients and Australians' middle market. So why are we here this afternoon? Well, we make it our business to know the issues and challenges of your businesses, to keep you up to date with changes and insights that have a big impact on the decisions that you make. So Pitcher Partners' recent Business Radar report showed us that Australian entrepreneurs and business owners remain confident and convinced of the future success, despite the economic and global headwinds. In fact, despite the pandemic, current challenges in inflation, rising interest rates, supply chain and worker shortages, businesses are more confident in the current and future success than they were pre-pandemic. Our Business Radar report provides qualitative and quantitative data from a broad base of survey of our clients. It also contains analysis and actionable insights from businesses, as well as Pitcher Partners financial experts. You can read more in the full report by scanning some of the leaflets that are on your seats today, as well as on our website. And for those that are watching on the webcast, the link should be prominent there on our website, and I encourage you to look at it after this presentation. So a windfall in revenue of $146 billion since the last budget, which was only in October, comes off the back of continued high commodity prices, high employment, and high corporate tax takes that are bolstered with high inflation. It is clear the government have taken a measured approach to spending this windfall, choosing to largely save the upside to the tune of about 80% and reduce the significant debt generated. The cost of living support and the budget focused on healthcare and welfare with more than $15 billion package of welfare increases, bulk billing incentives and energy bill discounts, which we'll hear of today. These measures will be duly welcomed by many that are finding these times tough. But the impact the spending may have on inflationary pressures and the RBA's potential rate hikes may not be as welcomed. But we have a thinly forecasted surplus of $4 billion for FY23, which represents the first surplus in 15 years. So it makes for some good headlines. The economic outlook, though, is not so rosy. Forecasted deficits for the following 4 years, showing that we may be in the red again for some time yet. There's also little in this budget for businesses, other than some energy and small-scale and capital investment concessions. But there is a bit there, and there was little there to hinder businesses' growth either. So the government have clearly taken a cautious approach in what may be seen as a missed opportunity for some true reform. Of course, for more in-depth analysis of the budget's announcements and the impacts, it's time that we hear from our great experts that we have joining us today. First up, we will have Catherine Birch to share with us her take on the budget and what its announcements mean for our nation's economy. A senior economist in the Australian economics team at ANZ, Catherine will be able to share insights concerning the labour market, business and infrastructure investment, and the broader Australian economy. Prior to joining ANZ, Catherine worked as a senior policy advisor economist for the Victorian government, an environmental economist for the Namibia Nature Foundation, and an economic analyst for the Biz Oxford Economics. So her diverse experience will certainly offer an insightful budget lens. Following Catherine, we will hear from our Yina Tang, a fellow partner at Pitcher Partners here in Melbourne. She specialises in tax consulting with expertise in income tax and Australian tax law for businesses, trusts and large groups. She provides tailored advice to a broad range of our clients from startups to multinationals. So there has been a range of government initiatives and tax changes designed to shore up our nation's economic resilience. And Yina will update us on what is changing and what is not changing as a result of this budget. Following Yina's presentation, we will invite both Catherine and Yina back up for some Q&A, and we'll be joined by Mark Harrison. Mark is a business advisory partner here at Pitcher Partners. Mark works closely with businesses of all sizes as their trusted advisor. He brings extensive experience to bear on client issues, offering informed advice, disrupting preconceived ideas, and leveraging the expertise of colleagues across our firm. We're delighted to have Mark join us here to take your questions with a spotlight on what the budget means for business. We hope you find this afternoon's discussion and analysis of the budget insightful. And now it's my great pleasure to introduce you to our first speaker for today's event. We feel very fortunate that you could join us here today, Catherine, and share with us what you see as some of the bigger impacts on the federal budget. And welcome, Catherine.
Thanks very much, Brian, and nice to be back here at Pitcher Partners. I was having a chat to Brian before. We've done a few of these budgets now and talking about how there's never really any surprises anymore that you get in the budget. Brian sort of talked about how I'll discuss how the budget might impact the economy, but probably just to lay the groundwork, are we going to change our economic forecasts on the back of this budget? No. So that kind of tells you what how much it will impact it in the overall scheme of things. But we do have a surplus for the first time in 15 years, and a big turnaround compared with what was expected in the October 2022 budget. Is that sound okay? Do I need to? Yeah, thanks, Joan. And look, this surplus, this 40 billion or more than $40 billion turnaround to a small surplus might sound a bit counterintuitive. If you've been reading the papers over the last year or so, there's a lot of doom and gloom out there. The economy is going to hell in a handbasket. We've got very high inflation, and we've had a significant increase in interest rates over the past year. The largest increase in a hiking cycle since the inflation targeting era began. But actually, the economy is still in a pretty strong position. You won't find that in any newspaper or anything, but actually the economy, in our view, is in a stronger position now than it was pre-pandemic. We've got a very tight labour market. Employment growth has been very strong. That means there's more income tax coming in. Spending growth is slowing, but it has been stronger than expected as well. That means more business revenue, and so that revenue stream coming in as well. Obviously, commodity prices are still quite high, and given that the budget always assumes very conservative price forecasts, that's another benefit that we've seen as well. So if we look at the first year, that 2022-23, yes, we're 10 months into it, just over 10 months into it now. But that shows that almost $40 billion turnaround, and that's all down to that dark blue bar, which is the economic parameters, what I've just spoken about now. That's the reason why we are in this position. Surplus doesn't last long, though. We're expecting, well, the budget is expecting that we slip back into deficit next year and then see those deficits grow further over the following couple of years. The key thing to note, though, is that those projected deficits are going to be smaller than what was expected just 6 months ago. Where are we? 7 months ago. Part of the reason they're smaller is the stronger starting point. Part of the reason is that the Treasury is now expecting that the economy isn't going to decline as much as they thought before as well. So that is a positive. There's also been quite a bit of reprioritization of spending as well. So we've talked a lot about, well, I've been talking a lot about some of the structural pressures, and you will have heard this on all the coverage of the budget as well. These structural pressures on the budget, the spending that we can't really cut/reprioritize, the spending that has to happen. And that's on some of the care sectors, the health sector, defence as well, interest costs and that burden too. But some of those reduction in costs, some of the reprioritization and the expected higher revenue does mean that we're going to see smaller deficits going forward. And that is a positive. That doesn't mean that we should relax though. We've still got a significant amount of debt that will continue to grow. Our interest burden is going to continue to grow as well. And we want to make sure that, as with every budget, we are spending the money in the most productive, beneficial ways that we should be doing it. So This chart, I won't go too much into this chart, it's payments and revenue, but essentially what we've seen is a bit of a reprioritization. So the government has decided some of the projects and policies of the former government, we're not going to do that anymore. We're going to fund some of the priorities that we have. And so now, since the October 22 budget and this budget as well, the government's now reprioritized about $61 billion over the forward estimates. One of the things that we saw really highlighted in the budget was that cost of living relief. So we've seen an increase to JobKeeper, particularly for the 55 to 59-year-olds, increased Commonwealth rent assistance, the largest increase in 30 years, bulk billing incentives, energy bill subsidies, and we've also seen a 15% wage increase for aged care workers and an expansion of the single parent payment as well. And these two things will disproportionately benefit women. One of the big questions is, how does this budget affect inflation? There's still quite a bit of spending in here. We have got 7% inflation. Still, yes, it's come down from 7.8%, but 7% is still very high. And if we are providing money to households or reducing the cost of some things like energy, that frees up cash that can then be spent on other things, which can add to the demand side and therefore the inflation problem as well. You would expect, given that we've now got smaller, still deficits, but smaller deficits going forward than we did, that should mean that the pressure on inflation is reduced. And I would also argue that while there is an inflationary effect here, the benefits of reducing poverty and the benefits of improving the pay and conditions for workers in a historically underpaid sector, particularly improving the attraction and retention of workers, has benefits that outweigh those marginal inflationary effects. I won't go too much into the tax side because I'm sure Uni will go through that. But while there's been a bit of tinkering, I guess, around the tax revenue side, the super concession changes, the petroleum resource rent tax, tobacco excise, these sorts of things, tinkering is certainly the key word there. So with the outlook, we think that actually there could still be that actually the revenue coming in over the next few years could actually still be a bit more positive than what the government has projected. Nominal GDP growth, the most important metric for the budget, has been incredibly strong this year. That's essentially been driven by the strength of the economy, but also prices. Inflation is actually a good thing for nominal GDP growth. And it means that the higher inflation is and the higher your nominal GDP growth is, the slower your debt to GDP ratio rises, or the more it comes down. And that's the key metric when we're thinking about where the budget is, how that budget position relates to nominal GDP. Inflation is actually good for those who have debt. And the government has quite a bit of debt. Now, we are expecting that nominal GDP growth will slow quite sharply in the 23-24 financial year, but we don't think it'll slow as much as what Treasury are expecting. And a lot of that is to do with what they expect for commodity prices. So this is one of the assumptions that the budget always makes. Commodity prices are going to come back down to some sort of average. They've actually upped it for iron ore this year. It's usually $55 US dollars a tonne that they return it to. It's 60 this year, so we get an extra $5. But we still think that the projections for commodity prices are quite conservative. So for iron ore, they're projecting it falls from 117 to 60 US dollars a tonne. We're expecting that by early next year, it's still going to be sitting at 95. For thermal coal as well, they've got it coming down from 260 US dollars a tonne to 70 a tonne by early next year. We think it'll probably be around 300 at that time. So there's still quite a bit of upside that we could see there in the near term. We have also got very strong population growth as well, and that is a positive for the budget too. So we've actually seen record net overseas migration in 2022. Big part of that is that, yes, there's a lot of people coming in now, not quite as much as what there used to be, but there's far fewer people going out. A lot of people who would have left anyway during the pandemic or during the last few years. So the government is now projecting we'll get net overseas migration of 400,000 this financial year. Pre-pandemic, we were sitting around the 280 mark. It's a big increase. So we're expecting, or Treasury expecting 2% population growth. That means more people buying more stuff, which grows the economy, increases GST take, and more people working and paying income tax. That's another positive. So again, on their broader economic assumptions as well, look, we're probably a bit more optimistic than Treasury too, particularly around the wage growth and the employment growth expectations. We're actually more positive on those two, which again means that your income tax take is probably going to be higher than it would be otherwise. If I should have prefaced this economic part with if things pan out the way they are expected to. While we have a central economic forecast, a central scenario, there's obviously a lot of uncertainty around the economic outlook at the moment. Banks overseas, what central banks are doing with interest rates as well. How well does the economy hold up over the longer term under these more restrictive rates? So there is significant uncertainty, and I do have some sympathy for the government in taking a bit of a cautious approach when there is quite a bit of uncertainty. But at the same time, you've only got a limited amount of time to get stuff done. So I'll just finish up on debt. Again, because we've seen these improvements in the deficits, so smaller deficits, we've actually seen the net debt projections. Net debt will continue to rise over the forward estimates, but not as quickly as was previously expected. And this is partly due to a reduction in the expected borrowing requirements as a result of the smaller deficits, as well as but although that's partly offset by an increase in the market value of some of the bonds that have been issued though. Lower issuance, higher value. So now, rather than net debt continuing to rise into the mid-2030s, it's actually starting to, projected to start turning around in the mid-2030s now. Just finally on interest payments, look, this is where interest payments have actually been revised down quite a bit. That yellowish line on the chart is the interest cost as a share of GDP that was projected in the October 2022 budget. That dark blue dotted line is what this budget is projecting. So really a combination of less debt issuance going out because the government doesn't need to issue as much, and also lower bond yields as well. But even with that interest cost burden is going to rise over time. We expect it, or the Treasury expects it'll get back to 0.8%. So just because we're in surplus now, just because we have smaller deficits than was projected, doesn't mean that we can relax and think that the budget is going to take care of itself. I'll leave it there. Thank you.
Thanks very much, Catherine. For those fascinating key economic insights, I'm pleased to hear that you're not going to be revising your forecast. Clearly, that means that the government has achieved what, in my view, it actually intended to with this particular budget. So good afternoon, everyone, and thank you for joining us here and also online. As Brian mentioned, I'm Yina Tang. I'm one of the tax partners here at Pitcher Partners, and it's my pleasure to provide you with an overview of the budget in terms of tax measures, together with hopefully some insights about businesses, individuals. So today, in terms of the budget, you'll have heard probably a couple of words, and they'll have been repeated all around. Balanced, responsible, modest, restrained. They've been bandied around in the media that you would have heard all day today as they dissected the budget from last night. But to be fair, they are also the terms that the PM and the Treasurer have been using themselves when they've been promoting this budget since the speech last night. It was Labor's second budget since it came into office, albeit only 7 months after it delivered its first. And although it was our hope within the wider Pitcher Partners tax team that there might be some political will on part of the government to embark on some meaningful tax reform, it is clear that the economic circumstances haven't exactly created the most conducive environment for it. So unfortunately, we are faced yet again with a budget that is very light on in terms of tax measures, but hopefully there'll be enough for me to entertain you this afternoon. The good news, as both Brian and Catherine have foreshadowed, is that in the lead up to the budget, it was talked about, leaked potentially, but it was then confirmed that we are apparently back in the black, albeit temporarily. As Catherine said, it was a $40 billion turnaround from just 7 months ago when the forecast was $36.9 billion deficit to a $4.2 billion surplus. It is the first budget surplus in 15 years since the GFC, and it is largely due to a surge in income tax paid by individuals and corporates. So a couple of statistics that I thought were interesting. For the first time on record, apparently, the job growth and rising wages will push personal income tax receipts above $300 billion, and that will represent more than 50% of the Commonwealth's total tax revenue. Higher commodity prices have contributed to an almost 29% increase in corporate tax collections, up from $101 billion to $131 billion. But having said that, it is also clear that the structural challenges in the budget remain. So the December national accounts show that personal income tax are now at a 2-decade high as a percentage of household earnings because of bracket creep. The NDIS continues to blow out, even as the Treasurer recommitted to securing its future in last night's budget speech. And spending across multiple sectors, including defence, healthcare, aged care, is expected to increase over the next couple of years. So meaningful tax reform, not tinkering, meaningful, is clearly needed to address the structural deficit in a more holistic fashion. But alas, as I mentioned, it wasn't to be. The centrepiece of this budget was really the government's $15 billion package to tackle the rising cost of living. So the highlights from this package are a $4.9 billion increase to welfare payments, a $3.5 billion increase to Medicare bulk billing incentive, which is apparently the largest increase ever, up to $300 billion co-funded with the states in direct energy bill relief for eligible households and small businesses. We understand that that is to take the form of $500 deduction from your power bills directly. There's $2.4 billion that has been committed to a 15% increase in Commonwealth rent assistance and a $1.9 billion increase to single parenting payments to extend the eligibility of the payment until the youngest child turns 14. So although these measures are welcome and clearly aimed at the most vulnerable within our community, there is clearly some concern that the injection of cash will further contribute to inflationary pressures, contrary to the Treasurer's stated aims, although perhaps, Catherine, today you might dispel those notions and say that it's all good. But notwithstanding this substantial package, there is no question that the budget doesn't provide a lot for Australian individuals that are not classified as vulnerable, but are contending nonetheless with significant cost of living pressures. For those individuals, the only relief on the horizon is the stage 3 tax cuts, which were conspicuously absent from the budget last night. So just to reiterate, the stage 3 tax cuts will kick in from 1 July next year and replaces the current 32.5% and 37% income brackets with a single 30% bracket that will apply to income up until $200,000. Now, Labor voted for the tax cuts when they were legislated, and they recommitted to them during their election campaign, but they've obviously been facing pressure to cut them and given the forecasts deficits on the horizon. It will be interesting to watch whether this surprise budget surplus will have any influence on the government's position, one way or the other. I understand that the PM was on breakfast radio this morning and saying that their position on stage 3 tax cuts haven't changed, but there is at least one more budget in which they could change their mind before they kick in. So let's not count our chickens. So the other thing I just wanted to draw to your attention is also that also as foreshadowed, the government did not seek to extend the low and middle income tax offset in last night's budget. So the Lamito or the Lamington, as it apparently is affectionately referred to, not by me, I'm not particularly affectionate, could be facing, people who were eligible for Lamito could be facing an increase in their tax bill of up to $1,500 when they lodge their 2023 income tax return. There was some good news for small businesses, with the government introducing a few incentives that are actually limited to the 2024 income year. And this is somewhat representative of this particular softly budget. It's a wait and see budget. So these incentives are not intended to run for more than or for longer than the 2024 income year. Of those measures, I dare say that the instant asset write-off would be familiar to all of you. It is the well that the government continues to go back to in order to try and improve business cash flow. Now, I have to say, I had a back to the future moment when this was announced, because the last time that the instant asset write-off was set at a $20,000 threshold for businesses with a turnover of 10 million or under was in the 2015 budget, before it was then steadily increased to the temporary full expensing measure that we're currently enjoying today. It does bear mentioning, though, that if the government hadn't announced this measure, then the instant asset write-off threshold would have been decreased and dropped to assets that are costing less than $1,000. And that would have been the case for the first time since May of 2015. The government also announced a small business energy incentive, which provides an additional $20,000 of deductions for businesses that turn over up to $50 million, which invest in energy efficient equipment. And lastly, the government announced a reduction of the GDP uplift factor for PAYG and GST instalments. Apparently, according to the statutory formula, they were supposed to sit at 12%. So the government has kindly cut that in half to 6% for the 2024 year. This is not a measure that is expected to impact the quantum of actual tax payable, but it nevertheless represents some cash flow relief for small businesses over the 2024 income year. Now, as welcome as these measures are, they are certainly not as generous as measures like temporary full expensing or loss carryback. And so I suppose I just wanted to take this opportunity to remind everyone that these are still in play for the 2023 income year. Now, together with the cost of living, affordable housing is another of the government's challenges. And so to encourage construction and supply of additional housing, the government confirmed its pre-budget announcement last night that it would provide new incentives for the build to rent sector. And they are an increase to the capital works deduction rate from 2.5% to 4%, which is available to all entities. And for managed investment trust specifically, a reduction in the MIT withholding rate from 30% to 15%. Now, it is proposed that this measure will apply to projects that consist of 50 or more dwellings that are available for rent by the general public on lease terms of 3 or more years and remain under single ownership for at least 10 years. We certainly welcome these measures and believe that they are a step in the right direction with respect to addressing the issue of housing scarcity, but the devil will always be in the detail. The government expects to undertake consultation on the relevant implementation, including the minimum portion of dwellings that must be offered as affordable tenancies. It therefore remains to be seen whether the final form of this incentive will be sufficient to actually entice the private sector to achieve the currently forecasted 150,000 rental properties to be built under this incentive over the next 10 years. Staying on the topic of MITs, the government also announced an extension of the concessions that are available to clean energy building MITs to beyond buildings, to data centres and to warehouses. But at the same time, it also provided an increase or required that the minimum energy efficiency requirements are increased from the current 5 stars or 5.5 stars to 6 stars. And they will apply to both new and existing buildings, although the government will undertake consultation on transitional measures for those existing buildings. Now, multinationals. They've borne the brunt of the integrity measures over the last few budgets, and this one is no exception. Last night, the government announced the introduction of a 15% global minimum tax and domestic minimum tax for large multinational and multinational enterprises with annual global revenue of 750 million euro, or that's equivalent to 1.2 billion Aussie dollars in today's terms. This measure is designed to allow Australia to apply a top-up tax on an Australian parent or subsidiary company where the group's income is taxed below 15% overseas, and also allows Australia to have the first bite at the cherry if the company's effective Australian tax rate falls below 15%. An underpayments rule will also kick in from 1 January 2025, which applies if no country collects the top-up tax. In addition, the government is also intending to expand the reach of Australia's general anti-avoidance rules to schemes which firstly seek to access lower withholding tax rates on income that is paid to foreign residents, and also to schemes where the dominant purpose was to reduce foreign income tax. Now, there has been a general consensus, I suppose, that schemes that are designed or entered into with the purpose of reducing foreign income tax is not subject to Australia's anti-avoidance rules. This is apparently going to change. I don't know how these provisions will be drafted into the existing legislation, but I suppose the concerning factor here is that although these measures will take place and commence from 1 July 2024, is that there will be no grandfathering of existing arrangements that were in place pre that date. Superannuation. I echo Catherine's comments. There's not a lot new in this particular budget. So having already announced and undertaken initial consultation prior to last night's budget, the government nevertheless reiterated their commitment to ensuring that the concessional superannuation tax rate for individuals with member balances over 3 million will be increased to 30%. Now, notwithstanding that the measure is expected to only impact 80,000 individuals, the budget papers indicate that by the 2028 financial year, which will be the first full year of receipts under this new regime, I was astounded to know that they expected to collect $2.3 billion from this regime. So just because consultation is happening, we have produced a submission to say that we don't support the current policy design approach, principally due to the departure from the current system to try and impose income tax on unrealised capital gains. We will obviously continue to consult with Treasury, but if you are interested, there is a copy of our submission on our website. In relation to the previous government's proposed changes to the non-arm's length income and expense rules, the current government announced last night that they will make amendments to the changes to limit the amount of income taxed as NALI at 45% to twice the level of a general non-arm's length expense. This is a welcome departure from the previously announced 5 times limit, but we do anticipate that there will be considerable complexity in the provisions, which will need to be managed. Finally, the government did not extend the 50% reduction on minimum drawdowns for pensions, which means that the minimum drawdown for 2024 will revert to the standard rates for the first time since COVID. Quickly running through some of the other measures that I wanted to draw to your attention. In the October budget last year, the government announced an exemption from FBT for electric cars. Last night, the government confirmed that the exemption for plug-in hybrid vehicles will end on 1 April 2025, although existing arrangements will remain eligible. From 1 July 2026, the government will mandate that businesses must pay their workers their superannuation contributions every payday rather than at the end of each quarter. And there will also be a 6% per year increase to the road user charge starting in FY24, taking it from the current 27.2 cents per litre to 32.4 cents per litre in FY26. This measure will reduce entitlement to fuel tax credits that are available to transport operators, leading to an increase in costs, which will most likely be passed on to business customers and then ultimately end consumers. And finally, what would a budget be without the announcement of additional funding for the ATO? So in this particular budget, only 7 months after the last one, the government is further extending the personal income tax compliance program for a further 2 years to the end of 2027. The additional funding is also intended to expand the scope of the program from 1 July 2023 to address what the ATO considered to be emerging risks, and what Treasury in their budget papers have specifically named deductions relating to short-term rental properties. So I thought that was interesting. The GST compliance program is also being extended by 4 years to the end of 2027 to promote GST compliance and to allow the ATO to develop more sophisticated data analytic tools to target emerging risks. So certainly we see a lot more ATO activity both in the income tax and the GST space over the next 5 years. Together with the compliance programs, the ATO will also be actively engaging taxpayers to ensure the timely payment of income tax and the super guarantee. This includes the commencement of a 4-year program to target debt collection, and also the development of improved data matching capabilities to detect and identify cases of non-payment or underpayment of SG in real time. So in short, this was a restrained budget with a very, very clear focus on cost of living relief for vulnerable individuals. Like so many budgets before it, it lacked any meaningful tax reform, but continued to double down on integrity and collection measures, all the while providing limited support to businesses in the face of the forecasted economic tightening. Now, the Treasurer has said that he is, quote, encouraged by the willingness of the Australian community to engage in a conversation to get the budget in much better nick. So hopefully by the time the next budget rolls around, there will be some clearer indications of how this government intends to address the structural budget deficits, and that not all of those difficult decisions that the Treasurer has foreshadowed that are necessary will come all at once. And with that, thank you, and I'll pass back to Brian.
Thank you, Rena. A helpful overview of the budget announcements. As you say, it can be tough to get excited on a budget night when the changes have mostly been announced already. We didn't get the reform many of us were hoping for. There's still plenty in the budget to get our head around. I'd now like to welcome back to the stage Catherine and Yena to join me for Q&A, as well as invite Mark Harrison as well to join us for a panel discussion and question and answers. So we've had a number of questions come through online in the room, and also from those watching at home. So that's been great. But please feel free to submit your questions. The Slido details up on the screen. Once again, it's been great to hear the presentations today, and thank you for joining today on the panel. Mark, seeing as you've just stepped up, I might start with you as the first question that's popped up here, and a simple one really at that, I hope. But tax matters aside and economics aside, what's in the budget for businesses? What are we seeing?
I suspect there's an echo in the room because we've already heard from our first presenters. It's not a lot.
Yeah.
The messaging I'm taking out, and I think the practice takes out to its clients at the moment, is in the economic forecast, firstly. While they're not dire by any degree, there's certainly a slowing economy. It reinforces that expectation that was probably set in the last interim budget. And so for our clients who are currently enjoying some reasonable economic growth, falling down to just over 1% over the next 12 months, continued wages growth, which impacts the bottom line of businesses, and continued inflation. I think we're trying to have our clients be prepared for what that may bring. And obviously then with the flow on of a slowing economy impacts debt cycles, funding, and those sorts of things. I think some of it will be very sectoral. So our retail clients, obviously consumption is meant to fall. I think we're down to 1% growth in household demand next year, which is off a lot higher base. I don't recollect the statistics. And then you've also got negative growth in residential building for the next 3 years. So I don't think there's a news flash in that, but it's going to continue to impact those sectors. So they'd be the key takeaways. I think hopefully for a lot of business, or for some businesses, if you follow the money, there are still going to be winners. Obviously a GP who's bulk billing is going to be a bit better off. If you're in hydrogen, green energy, that's probably not our client base a lot, but if you're developing those sort of resources, then there's some positive outcomes in the budget. If you're in the right areas of defence, which is a political flip from where they had been intending to spend their money, there'll be some businesses who are now a lot better off. But other than that, I think you've really just got to make your headway on your own in a tougher economy.
Yes, indeed. I mean, it certainly sounds, obviously the forecasting is not that rosy. And we're focused today, I think, all on the Australian forecast positions as well, and how that might impact the market. A question's come through in relation to the US position and a US recession. Maybe one for you, Catherine, is, how does that impact the forecast, and how does it impact the Australian economy in the context of a potential US recession on its way?
As I was talking about before, there has been a lot of doom and gloom on the economic outlook. And actually, we think that doom and gloom has been overstated both here and overseas and in the US as well. When labour markets are as tight as they are at the moment, it's really hard to see a sharp deterioration and a deep recession in economies. In the US, job vacancies are still 1.6 per unemployed person. It's come down from a peak of 2, but the thinking is that needs to get down to about 1 for it to be consistent with inflation being back to target. When I go and talk to clients, and I'd be interested to hear the take here as well, most clients aren't going, demand is slowing, we're not getting enough demand anymore, that's the issue. Most clients are still saying to me, we can't get enough workers. And I find it really hard to see a damaging recession either here or in the US when we've still got so many vacancies, when there's still so much excess demand for labour. Because most people who want a job at the moment either have one or can find one pretty quickly. There's always going to be exceptions, particularly if you're long-term unemployed or you have a disability or another barrier. But most people who want a job have a job. And if you can hold on to your job, and when I see job vacancies at the level they are now, and in Australia, that job vacancy to unemployed ratio is still almost triple what it was pre-pandemic. If most people can hold on to their job, hold on to their income, they're much more likely to be able to keep making their mortgage repayments, rent payments, buying necessities. So there might be a shallow recession in the US. Our central scenario is that actually it's not a damaging recession like we've seen in the past. I will highlight there are risks though. We have seen bank failures. If there are more financial stresses and we've underplayed that is a risk to the downside, and that would have more detrimental impacts on the Australian economy. Also, if we see rates rising and inflation not coming down quickly enough, even though demand growth is slowing, that would mean all else equal that rates need to go even higher. And the higher and more restrictive that rates have to go to bring inflation back down, the more likely we see a recession.
I guess that leads to the question around where do we see the interest rates topping out? I mean, it's coming through in a few questions here online. I think it's a question on many people's minds.
If you've got a mortgage, you might not want to hear this, but our view is that there'll be one more 25 basis point hike in August. Look, the timing, who knows at the moment after the pause and then the flip back to a hike in April and May. But where our view differs a bit is that we don't see any rate cuts until late 2024, when many other forecasters are expecting rate cuts to start either late this year or early next year. And the reason we think that is that inflation is still far too high. Demand is still in excess of supply. That gap between demand and supply is only going to close slowly. And as long as there's this gap, inflation is going to be too high. And we think that the greatest risk at the moment is not that the RBA has done too much and it's going to push us into recession or a damaging recession. We think the bigger risk at the moment is that they don't do enough. It's not restrictive enough. Inflation is coming down, but then stalls above the RBA's 2 to 3% target band. If that was the case, then down the track, the RBA has to take the cash rate even higher, even more restrictive, and that recession risk increases and the potential damage for households and businesses increases as well. So you really don't want to have a second go at bringing inflation back down. And that's why we think that rates will need to be higher for longer.
Thank you for that. Not the best of news, I'm sure, for many, but I think it's one that's been flagged plenty of times over.
I've got a mortgage as well, so.
A question that's come through on the tax side, Yina, and one that we've spoken about a couple of times today already, just around what does meaningful tax reform actually mean, and why do we want it?
Yeah, so it is an interesting question, and while I was doing a bit of reading around this, I had occasion to come across a statistic which I found astounding, which is of all of the amendments to the tax law in relation to companies since 2015, apparently 91% of those amendments have been integrity measures. So what that really means is that we really haven't had a change to the substantive tax law for a very long time. And when you consider it in the context of what Catherine was talking about in the, or the spending that we have to have and that we can't cut back, then the government has to make up that revenue somehow. Now, it's been trying to do that, with all of the collection mechanisms that I talked about, funding ATO programs, trying to find the people to, find the tax that they're not collecting under the current rules. But really, if we think that there's going to be this structural deficit going forward over the next couple of years, the government's going to have to find some more holistic way of balancing its books, whether that be a different regime, whether they want to, try and target a different market or place themselves differently. Plenty of governments, previous governments have tried to do that, consolidation, for example, bringing that in, TOFA, that sort of stuff, where it's actually a fundamental shift in the tax system. That's probably what is really needed to address that structural deficit, rather than the tinkering that we've been talking about.
It actually leads on nicely around corporate tax rates as well. A question that's come through here, then whether we see any potential changes in the corporate tax rate and what that might do for businesses.
So my personal view is that we're probably not going to see any changes in corporate tax rates, certainly not while the budget is in the precarious position that it currently is. As much as we say that the government has budgeted for lower commodity prices, I'm not sure that it's willing to trade that with a lower corporate tax rate. And let's not forget, though, that the lower, it was a couple of years ago, and I forget how long, that the general corporate tax rate was supposed to come down to 25, and yet they've decided, government at the time decided that, or they couldn't get it through government, that the larger corporates could actually come down to the 25%. So now we've got this halfway house where small businesses do get the 25% base rate, and yet somehow, if you don't qualify for that, you're still at the 30% rate. So no, I don't see any change to the corporate tax rate in the foreseeable future.
Thank you. Yes, it's just a little bit more confusing, isn't it, now, with two different rates to deal with. A few questions coming through, and I think targeted from an economics perspective on net debt. 24% of GDP, is that too high? And are you able to unpack some of the further detail around debt actually being good in an inflationary environment?
Oh yeah, sure. Not so much debt, but if you hold debt, you are benefited by inflation, because your debt is in nominal terms. So for example, as the economy grows, that debt to GDP ratio is going to be lower than it would otherwise if your prices are going up more quickly. It's the same as if, when you take out a loan, for example, a home loan, that debt is in nominal terms. Your wages and that sort of thing increases, and actually means that your income to that debt, even if the size of that debt doesn't change, is going to be higher. your debt to income will be lower because your income is higher. So that's essentially what I mean by if you hold debt, inflation can be a benefit. Is debt too high? It's pretty high, but on the global scale or on the global stage, it's actually comparatively still quite low. As an economist, we're not concerned too much about debt as long as that debt is being put to a productive use. If you're borrowing to invest in policies or infrastructure, for example, that are going to have long-term benefits, that are going to improve productivity, that are going to grow the economy more quickly, so your return is actually greater, that's fine. If you're borrowing to invest in policies or projects that are not going to be beneficial and don't have the return on investment, whether it's financial through a financial return, or whether it's through spending on, education or health, that means that people are more skilled and healthy and are able to produce more in the economy, the return that way, that's fine. But I think one of the interesting things we've seen announced sort of in the lead up to the budget, but will take some time to happen, is a review of the infrastructure pipeline. Usually the budget is used as an opportunity to announce sexy new infrastructure projects that get a lot of headlines. The case this time is actually we're going to review that pipeline and make sure that what we invest in are actually going to be the best projects that are going to give us the biggest returns. So that's a positive, but there is still very much a necessity to manage that debt and to have a long-term plan to actually reduce that.
Thank you. A question that's come through here for you, Mark. I guess with limited government assistance for business, what should actually businesses be doing in the face of a slowing economy that is to come in over the next few years?
I guess, firstly, I don't think any of us expect government to be giving a handout to business. So, but obviously they've got to create a productive economy to allow business to thrive, and obviously to pay taxes to fund all of the spending initiatives they've got. If we're not seeing structural change to the economy and we're seeing a restrained economy with lower growth and etc., I think from our perspective, if we look at our clients, most of them have stripped the cost out of their businesses already. COVID did that, and they haven't exactly, it's not elastic. They haven't put that cost back in. So you'd probably say that they can't do anything more on the spend, on the saving side. So the focus has to be either on productivity gains, which is investing in your business, technology primarily. Unfortunately, obviously the tax incentive for that is being wound back considerably, in shifting away from TFE to the lower incentive. And after that, I think it has to be on defensive revenue. So you've just got to know your client. You've got to understand what your marketplace is doing. Will your core customer, if you're in a B2C sort of a world, be impacted by the slowing economy on the household consumption pattern? What's going to put you ahead of your competitors to retain the revenue? Because that's the only fight you've got left if you've stripped out all the cost. Aside from that, obviously tighter times, the harder funding, so shoring up debt positions right now or equity if you need it, so that you don't have to do it in a slower economy as well, is something that obviously makes a lot of sense and is straight out of an old playbook that we've always run. But that'd be the main things that we're talking to our clients about. It's about being proactive rather than just defensive.
Fantastic, thank you. I guess you mentioned capital investment and the benefits that have been coming through in the context of the temporary full expensing, and we've seen some updated rules that came through last night on that front as well. And actually, the next question might be more of a tax question for you, Yina, just in relation to the energy efficient equipment. So what types of energy efficient equipment are eligible for the small business energy incentive?
Yeah, there wasn't too much detail in the budget last night. From what we understand is that it's not designed for assets that generate renewable energy, nor is it designed for things like electric vehicles or capital works. We believe that it will be confined to Div 40 assets to things like batteries, perhaps, to energy management, to energy storage, heat pumps, alternatively to assets that are more efficient in terms of their use of electricity. But the budget did say that they will undertake further consultation to determine the actual eligibility criteria before they implement.
Questions been coming through, I think, in relation to the housing sector and property, and specifically, we talk about this huge increase in migration, 400,000 people, net migration next year, and the highest it's been for a while. I know it's a good thing, but won't this put pressure on housing sector? And I guess an initial question for you, Catherine, I guess a follow-up question as to what was in the budget from a housing perspective, either to Mark or Yina, that you saw that might help alleviate some of those concerns we have with respect to the current housing crisis.
Yes, very strong migration will put more pressure on the housing market, but the housing market was already very tight before we saw this strong recovery in migration. And that's because of a few things. One of the more interesting reasons, well, interesting for an economist, is that the average household size has actually fallen quite a bit during the pandemic. It fell by about 0.1 people per household. Doesn't sound like much, but you multiply that across every household in Australia, and the RBA estimated that that added dwelling demand equivalent to about 140,000 dwellings. So that was one reason that explains why the housing market became so tight, even though we had very low population growth during the pandemic. There's also some supply side constraints as well. We want to build a whole lot of houses, but we haven't been able to because we haven't been able to get all the workers. There's been supply side constraints, that sort of thing. And also just the weather's been pretty bad over the past year in Australia, which makes it hard to build stuff too. So that supply side is also constrained. So yes, too long didn't read, it will, but the housing market was already very tight. And that's why we do need to focus, I think, on the supply side as well as the demand side, which tends to, in budgets, just keep getting pushed up.
Yeah, well, that's right. And I guess speaking to the supply side, there was the BTR changes. Yina, was them? I mean, is it going to make a material difference? And what else did we see?
Not a lot else, really. Certainly nothing to stimulate the supply side of the equation. I think there might have been some announcement to help the buyers, but I'm not necessarily sure that solves your problem. And yeah, it certainly makes it worse. And the other point I would sort of make also is that, you know, listening to Catherine talk before about how we're expecting net migration of, 400,000. And yet when you look at the build to rent incentive, it's designed to provide 150,000 dwellings over the next 10 years. I don't know that it's really doing very much on that front.
GST rate. It's the never-ending question and topic of conversation. What have we seen, and is the government flagging any change to the GST rate? Have you seen anything come through that might give us a hint of the future budgets to come?
Oh, this is me venturing into dangerous territory. I speak of things I know nothing of, other than 10%. But there are GST experts in the room, I do believe, so I will defer if somebody else wants to say something. But in my view, I thought, in my very ignorant view, I thought the GST hikes were off the table. There's in the current inflationary environment where you've got the cost of living pressures, I can't see the government being brave enough to stick their head out and say the one meaningful tax reform we want to do is to hike GST that will apply to everyone.
It goes hand in hand with wider tax reform.
That's right.
And the broader sort of changes that we'd hope to see.
Yeah, that's right. And I think if you generally look at, overseas jurisdictions and things like that, a higher GST generally comes hand in hand with a lower tax rate. So I don't know where the government wants to go on that as well.
Thanks for that. A question that's come through, interesting one, I guess, with respect to the current government. What's the best business sector to be in or invest in under the Albanese government? Do we have a view on that? Do I throw it to you, Mark?
Oh, well, we'll start with the opinion for this week.
Yeah, indeed.
Well, if you look at the budget, there was some startup funds. So I guess there is a new fund to start up with about 400 million in it. I guess that's if you're looking for some grants, and it's not meant to be a loan structure, it is free money. Once they announce how you can get into that, I guess there's a win there for you. If we took broader, obviously, if you can help them make rockets or anything on the defence side or flip from when you used to be able to make tanks, but not going to buy anymore, then that'd be terrific for your business. After that, you're probably better if you're in aged care today than you were yesterday, because at least there's some funding for your wages increases. Doesn't make it an attractive investment outside of my remit. But yeah, following the money is always the best way to do it.
Question just coming through with respect to commodity prices. So we talked about this conservative commodity price estimates in the past, and it's obviously buffeted the budget outcomes and provided a little bit of a soft cushioning. So how critical are the commodity prices to this year's budget and to the forward estimates? We talked about it being obviously still the forecast being low. Does it make a material difference with respect to the budget that we're for the next 5 years, and will it continue to play a role in providing additional, I guess, cushioning and buffering for these future spends?
I think definitely in the near term. I mean, just thinking about talking through the Treasury's assumptions versus what we're expecting, particularly that thermal coal one. I think they've got $70 a ton, where we think it might be around 300 still. I haven't got a number off the top of my head as to what that would add to the 23-24 balance, but it's not small. It's pretty material, and that has been one of the key contributors to that $40 billion turnaround. So as long as commodity prices remain very elevated, and look, we think for most commodities, they have passed their peak. They will be sort of gradually coming down, but not coming down back to where they were pre-pandemic. That will still mean that there's quite a bit of risk for upside there. And that's a key reason why we are expecting that actually the deficits, the projected deficits, even though they've shrunk over the next couple of years, could potentially be even smaller. And I know there's some economists out there who are expecting that next year will be a surplus as well. I think it's a long way off. A lot can happen in the next 12 months, but you can't rule that out.
Make for another great headline, wouldn't it? 2 years of surplus and beyond.
I haven't seen any Back in Black mugs for sale yet, but surely they're coming.
Yeah, the Back in Black mugs, they're only here for a short time, and then no one wanted to talk about them for a while. I'm going to ask it because it's here a few times. Stage 3 tax cuts. Obviously, we talked about how they will be. They are currently legislated. Labor have approved them, and they are continued to be in the budget. Not a word was spoken last night. I guess 2 questions. Will these go ahead? And second question for Catherine also, how much do these stage 3 tax cuts have a play on the deficits of the future budget? But maybe maybe actually start with how important are they with respect to the budget, and then we can go around the room and decide whether we agree they're going to be here at this time next year or not.
Look, they are important, particularly if we're still in this scenario with structural deficits projected. Look, I'll give you my take on if I think they'll be around. I think they will, but I wouldn't be surprised if they will be amended in some way to address the disproportionate benefit they will have for higher income households. That seems like a very Labor government thing to do. Those tax cuts will be coming at a time when the economy is likely to have slowed down quite a bit. Whether it depends on where inflation is as to whether that will be something that will be a net positive or a net negative. But look, Yenia talked about how over 50% of the tax take now is income tax, and a lot of that is to do with bracket creep. So having them in some form to address the bracket creep that households are experiencing is smart, I think.
So it's certainly not going to bring an indexation to help us. So they need to have something to adjust for bracket creep. What do we think? What's your thoughts on where it might land over the next 2 years?
I've flip-flopped on this a lot. So I suppose this is an opportune time to say that anything I say was my opinion and not the opinion of Pitcher Partners or the Pitcher Partners tax team. But I think they'll stay. And it's very tentative. And that's purely because of those statistics that Catherine was sort of mentioning is, how much higher that personal income tax take is. and how much it's over and above what it was budgeted to be. I mean, the corporate tax take being higher than what it was budgeted to be, we can understand that because the government budgets in commodity prices are lower than what they actually are. But when you count personal income tax, all of that is due to wage rises and due to bracket creep. And so it will be really, really interesting to see what next year's budget will be, whether we might still be in a surplus for reasons that include personal income tax, because I do wonder whether the government has put themselves into a position where if you've got 2 budget surpluses in a row and then they decide to cut them, you know, is that a position that is then defensible? Yeah, that's just my 2 cents.
And I guess to round it out, because it's boring to have everyone agree, and because everyone's talking very rationally about economics, I actually think it'll be a political decision. We've had a budget that was very much lacking on revenue side change this year, and I don't think they can help themselves to keep their core constituency. They will do something to take away from the top end of that tax cut and look after Middle Australia, but so they will change it. They'll probably leave some benefit there to say they've addressed bracket creep, but I think that it will be less for the top end of the market and more for the ordinary Australian, which is a horrible word, but
More tinkering.
Well, I will say that I think on that point, they've put themselves in a very smart position, because either way that you see it from next year's budget's perspective, if they decide to keep it, they committed to them. It was status quo. It's previous government's fault. And if they decide to cut them, great news, return the budget to surplus. We take all the wins.
We'll certainly hear about it. Questions come through in relation to the super changes and the extra 15% tax on the adjusted increase. I guess the broader question around taxing unrealised gains, it's pretty dangerous territory, but there was little more in the budget last night regarding it. Is there still some way for this to play out over the coming years with respect to the legislation of those rules on super balances over 3 million?
Not being a superannuation expert, I'm probably not the best person to talk to about this, but given that the government have given themselves until 1 July 2025, which is post the next election, I think that they will spend this time tinkering with the policy and the policy intent and the policy design. I think moving into taxing unrealised gains, particularly of unrealised capital gains, that's revenue gains, it's probably something that's a little bit more familiar to taxpayers, but taxing unrealised capital gains would be certainly a foray into unknown territory and would be, I think, potentially a opening of the floodgates, or with whatever that terminology is. So I think there'll be a way to go with submissions and consultation, and then there will be a final plan to take to the next election.
Great, thank you for that. Time for one more question. A broader one, an economics one as well. Catherine, the outlook for productivity, where are we heading with that? Obviously, post-COVID, we've seen a dramatic drop, and is it rebounding, or where do we head from a productivity perspective across the country?
Yeah, it's not great. Productivity growth had been very weak pre-pandemic for several years. Our economic growth was being driven by population growth rather than productivity or participation so much. Look, the budget is assuming that productivity growth will be average 1.2% over the long term. That's in line with the 20-year average, the past 20 years. But as you mentioned, Brian, we saw a bit of a surge in productivity early in the pandemic when everyone was sort of working very, very hard, I think, and a bit worried about what was going to happen. We were working with more constraints as well. But after that surge, we've actually seen the level of productivity fall over the past few quarters. Productivity for economists is essentially the most important thing in the long run. And we've actually had a The 5-year productivity inquiry from the Productivity Commission was published just a month or two ago, I think. I'm really keen to see the government actually do something with the very, very long list of recommendations in this inquiry. The last report they did essentially gathered dust on a shelf. We didn't see much of that implemented. I think the good thing about the long list of recommendations to improve productivity in Australia is that there are plenty of opportunities to do this, and we need to take them, but it's a bit of a short-term pain, long-term gain. Particularly things around the workforce, around the service sector, the energy transition, tech and innovation is a big part. Australia has not been doing very well at all at that tech uptake and then diffusion of the tech as well. There are plenty of opportunities for us to improve our productivity. We need to make the hard decisions to actually get those happening and accept those short-term costs. I really hope that, you know, maybe in the next budget we see some more on that, but I'm also a little bit cynical too after the past several years.
We've been waiting for tax reform for a while. I think we might be waiting a little bit on productivity, but there's plenty of good things that can be done. Look, that's all we have time for on the Q&A. Thank you everyone for your questions that you put forward, and thank you to our panel for their insight this afternoon and evening. Can we give our panel a round of applause? Thank you. Also, we're just at the end of the time for presentations this evening. I think we've covered all the big hitting items out of this year's budget. As always, budget forecasts are predicated on a complex set of assumptions and timelines and priorities. History has shown us that these assumptions, timelines and priorities do not always turn out as anticipated, particularly in today's economic environment. But as we've heard, staying flexible, efficient, productive will be important as ever for every Australian middle market business in the year ahead. And it's clear that from this budget that businesses cannot expect handouts. It's been wonderful to see so many of people here today. Thank you for taking the time to join us here and online. I'd like to thank also the wonderful team here at Pitcher Partners, my fellow partners and colleagues, for everything that goes into preparing for this event, as well as all the collateral analysis that was released in the early hours of this morning. Special thanks to our exceptional tax advisory team here and also the client experience and marketing team that make this all possible. Today's session has been recorded, so we will share the recording with you later, I think tomorrow afternoon. You can share it with your friends and your family, or just re-watch it one evening when there's nothing better on Netflix. Before I wrap up, we'll have some door prizes. So I'll invite Catherine to help me select the door prizes. We've got one for someone in the room and one from a live stream participant as well. But maybe Catherine, if you can draw and announce the name for our winner in the room here. Bob Tolliday. Thank you. Congratulations. You'll be taking home a Hamper Emporium Glenmorangie whiskey tasting hamper. Congratulations. Not too bad. And our team here selected a live stream door prize. And that is going to Lauren Brown from Cador Properties. So congratulations, Lauren. You'll be posted out Hamper Emporium Moe and Gourmet Nibbles hamper. So thank you again for joining us today. For those that are here, I hope you can join us for some canapes and drinks and catch ups. Have a good evening and look forward to seeing you all again soon.